Oil jumped 3% today after a tanker burned. Your energy bills are about to rise, while the war trade finally wakes up for real. Thursday, July 23, 2026. Like and subscribe for daily market updates. Today's agenda: Market Snapshot. The war trade finally arrives. Crypto ignores earnings chaos. Oil shock gets louder. Fed policy under pressure. Up next, the war trade finally arrives. Let's look at where things stand right now. The S&P 500 sits at 7,499, down a fraction of 1%. This means the broad market is barely moving despite noise about earnings and war fears. Why does this matter? Because when indices stay flat, while headlines scream chaos, it usually signals that big institutions are waiting for clarity before committing more borrowed money to positions. The Nasdaq dropped 0.5% at 25,691. This tech-heavy index is sensitive to interest rates right now. The 10-year yield ticked up 63 percentage points, putting pressure on growth stocks looking for cheap capital. You see this often when the central bank signals it might keep rates higher than expected. Gold looks different today. It closed at $4,101. That is a massive level because it finally broke above 9-month lows after weeks of stagnation. This move tells you that investors are starting to fear for their wealth in a safe place, even if the stock market isn't crashing yet. Oil surged 3% and now sits near $89.46 per barrel. That price is critical because shipping lines and grocery stores pay directly into fuel costs. If oil keeps climbing toward $96, as some analysts predict, airline stocks will take a hit overnight, before anyone admits it officially in public statements from central banks around the world. The dollar index held steady at 111.11, with no real change today. This stability is surprising given how volatile everything else looks. It suggests that global trade flows aren't collapsing yet, even if global political tensions are heating up. Meanwhile, crypto markets are doing something completely different today. For nearly 2 weeks, gold stalled near $4,000 as investors awaited a definitive trigger. Now, it has broken above $4,100, signaling that demand for safe havens is accelerating, and the classic war trade has finally awakened. This surge matters because fear moves markets without official permission. A tanker struck and set ablaze off Saudi Arabia sent oil prices shooting toward $96 after President Trump threatened to bomb Iranian infrastructure. That single event changed everything. Supply fears are intensifying rapidly. You might wonder why gold did not jump sooner. The answer is that traders front-run rate changes before central banks admit them in public statements. They wait for tangible threats like burning oil or missile strikes to confirm worst-case scenarios. Once confirmed, capital flees risky assets and piles into precious metals. This dynamic explains why gold climbed 3 sessions despite high yields elsewhere. Investors are realizing inflation may not be solved by policy alone if global conflict disrupts supply chains further. Consequently, physical gold becomes the preferred hedge against currency debasement and systemic risk outside the dollar system entirely. The market is pricing geopolitical instability as a primary driver of asset allocation shifts. Supply chain disruptions combined with energy volatility create an environment where traditional monetary tools lose effectiveness quickly. Market participants are no longer waiting for verbal warnings from policymakers. They act on concrete evidence of conflict escalation. The breach above $4,100 signals a structural change in investor sentiment rather than a temporary spike driven by short-term news flow. As threats to global infrastructure intensify, the premium on hard assets continues to expand rapidly across all major financial centers worldwide. But not everything is calm. Energy markets are getting very loud right now. The quarterly earnings gauntlet concluded with a sharp divergence between traditional stocks and digital assets, defying standard logic. Tesla reported its financials, yet executed a strategic rate change by retaining its entire Bitcoin treasury rather than liquidating positions, as Wall Street strategists had forecasted during uncertainty. Simultaneously, Alphabet's artificial intelligence division posted revenue figures significantly exceeding consensus estimates, a trigger that typically propels major technology stocks to new highs and fuels broader market optimism. Despite this backdrop of corporate strength, Bitcoin remained remarkably inert today, trading in a tight range near $66,000, while global headlines screamed about escalating global political conflicts. and surging oil prices threatening inflationary pressures elsewhere. Ethereum displayed similar resilience, holding steady around $1,900 even as instability rocked traditional financial centers worldwide. This phenomenon occurs because crypto markets have increasingly decoupled from the immediate, unpredictable price swings of equity indices, when institutional investors shift their mindset from short-term speculation to long-term treasury management. Tesla's decision to hold its assets signals a fundamental change in narrative. Selling during crises may be an outdated reflex rather than sound strategy, suggesting that digital reserves are now viewed as stable store of value instruments capable withstanding big-picture economic turbulence without panic dumping. This calmness is particularly striking given the intense scrutiny these mega-cap companies face every quarter from analysts and media outlets alike. However, this tranquility masks underlying fragility inherent in high-beta assets. If either Bitcoin or Ethereum breaches their current critical support levels, a threshold often tested during periods of elevated, unpredictable price swings, the markets could react with disproportionate speed. Unlike traditional stocks where price discovery takes days to settle after an earnings miss, these digital asset classes can reverse course within hours due to algorithmic trading and leveraged positions. Without the usual warning signals from Wall Street analysts or scheduled economic data releases that slow down equity corrections, investors face a reality where unpredictable swings happen without preamble. Consequently, portfolio managers must recalibrate risk models, recognizing that holding crypto during earnings chaos is no longer passive, but an active bet on institutional adoption, overcoming short-term fear of missing out on traditional market rallies. Let's check how the broader economy is reacting to all this energy volatility. The oil shock has intensified significantly, defying hopes of a cooling trend, despite weeks of escalating Middle East tension. Brent crude surged again to approach $96 per barrel as traders recalibrated models based on fresh intelligence regarding global shipping vulnerabilities. A tanker was struck and set ablaze near Saudi Arabia, instantly shattering supply confidence among investors monitoring critical maritime choke points like the Strait of Hormuz. This physical disruption is not merely a headline. It represents a tangible threat to approximately 20% of global oil trade flows, forcing immediate reevaluation of inventory buffers across major consuming nations in Europe and Asia. Compounding this logistical nightmare, President Trump escalated rhetoric by threatening airstrikes on Iranian infrastructure should attacks persist unchecked by international forces directly or indirectly involved in the current conflicts. This global political rate change introduces a second-order effect, where market unpredictable price swings could extend beyond energy stocks into broader commodity complexes as hedging costs rise sharply. Historically, supply shocks of this magnitude often defy quick adaptation, unlike previous instances, where markets absorbed initial strikes within months following early-stage conflict escalations last month. Today's environment suggests prolonged uncertainty across multiple fronts simultaneously. Worldwide right here and now, the consensus that prices would stabilize quickly has evaporated as the war enters its nearly 2-week mark with no sign of de-escalation. For investors, this reality demands a strategic shift away from short-term speculation toward long-duration hedges against sustained price floors above current levels. Portfolio managers must prepare for increased unpredictable price swings premiums and potential supply chain bottlenecks that could ripple through manufacturing sectors dependent on petrochemical feedstocks derived directly or indirectly from the region's output today. Finally, let's wrap up with what this means for your portfolio tomorrow. The Federal Reserve stands at a precarious crossroads, where the promise of an imminent interest rate pause collides with stubborn inflation. This tension emerged sharply after last month's meeting concluded earlier than anticipated, leaving markets scrambling to interpret signals amidst low probability but high-impact risks from global instability that could dampen domestic growth over time. Central bank officials are now scrutinizing global political flashpoints before committing to any rate adjustment in the coming weeks, recognizing that premature easing could entrench price stickiness. The mechanism is delicate. If inflation fails to cool sufficiently despite recent data showing tentative improvements across housing starts, retail sales velocity, and manufacturing output levels tracked monthly by government agencies monitoring global economic health, a rate change back to hiking, rates becomes increasingly likely. Historically, the Fed has often waited for sustained disinflation before cutting, fearing that premature action in 1970s-style stagflation scenarios could lead to decades of policy error. Today's second-order effects are already rippling through fixed-income markets. Bond yields remain elevated as investors price in a prolonged, higher-for-longer rate environment, rather than the quick relief many expected. For concrete investor implications, this uncertainty demands a defensive posture where duration risk is minimized, and cash equivalents serve as ballast against potential unpredictable price swing spikes from external shocks. Equity sectors tied to borrowing costs face challenges if rates resume climbing, while real estate values remain fragile. The market must navigate this foggy landscape without assuming the worst or best-case scenario will play out linearly, requiring a nuanced approach that balances yield-seeking opportunities with capital preservation strategies as policymakers weigh every data point against their dual mandate of price stability and maximum employment. Markets show a clear divide between safe haven assets and tech stocks. Gold surged above $4,100 as real-world geopolitical threats replaced abstract economic fears, while oil prices climbed toward $96 driven by escalating supply chain risks from recent attacks in the Middle East. Conversely, Bitcoin held steady near $65,600 after Tesla decided against selling its holdings during volatile earnings reports. Investors remain cautious regarding Federal Reserve rate decisions as inflation data shows mixed signals across housing and manufacturing sectors before any potential policy shifts occur next week. Thanks for watching Market Pulse Daily.